Silver Stacker here. Hope you're doing well. Welcome to another live stream. Happy Easter to all of you watching on this lovely Easter Sunday. Now, today we are going to talk about the current setup for the price of silver because honestly, it's hard to understate how bullish the current setup is, at least from my perspective. So, the last time I spoke with all of you was last Thursday. And in that live stream, I had mentioned that this coming Monday, that would be tomorrow, April 1st, we could potentially see a big move in the price of silver. Now, also, I would anticipate that would be accompanied by a big price move for gold. There were a couple reasons for that. The first one was the fact that on Thursday, which happened to be the last trading day of the first quarter of 2024, we saw gold closing at new record all-time highs for a daily close, for a weekly close, and a quarterly close. So a very significant day on Thursday. We saw the price of gold breaking above the psychologically very important level of 2,200. Gold breaking out. Silver put on a good gain that day as well, but silver still remaining incredibly range bound, incredibly undervalued relative to gold in the current scenario where we see gold breaking out to new all-time highs and silver is still at just half of where it was in 2011, its previous high. So what has happened since the last time we spoke? Well, we got some data on Friday. This was something I was suggesting we keep an eye on here. The Fed's favorite measure of inflation, the PCE data, was released on Friday, which was closed because of the Good Friday holiday. And according to CNBC here, this report, the inflation rate rose in line with expectations. It was 2.8% year over year. That's what was expected. Now, notably here, the core PCE, excluding the volatile food and energy categories, we had the core PCE month over month actually coming in below expectations, only slightly, but the expectation was 0.4%. Year over year, it was as expected at 2.5%. So that's pretty important because one of the dynamics that we have witnessed recently is that when we get inflation data that appears promising, that the Fed is being successful in bringing inflation under control. Now, I mean, I get it. You might not trust the official data, but investors, trading algorithms, everything looks at this stuff. And when those numbers come in at or below expectations, that is a very positive thing for the precious metals. So tomorrow, I think that given the fact that we received these slightly, ever so slightly better than expected inflation readings for February, it's a very positive thing for the precious metals this week. Now, I mean, look, nobody can time markets to a day or an hour consistently. Anytime you do that, it's like, wow, the stars aligned and, you nail the timing. Typically, you're not going to be able to sell at the bottom, or rather sell at the top, buy at the bottom of a trough. It's very difficult to time things to the day, but I think if ever there were a candidate for perhaps a breakout in the price of silver, it very well could be tomorrow, or at least sometime this week. Now, that might not be the case as well. I mean, obviously, I even hesitate to make any kind of timing-related forecast, except I just think it's, fascinating when things do seem to be aligning for a big move in the price of silver. I mean, who knows? It could get smacked down. As we know, there's some chicanery in the paper markets. However, there was another development on Friday as well. It wasn't just the PCE data. It was also Jerome Powell. I want to kind of talk about some of the things he said. And again, this is all very important because none of this has really been priced into these markets yet because they were closed on Friday. Before we talk about Powell, if you do want to get some gold or silver, and listen, I mean, now is, I think, one of the best times for new stackers, especially in terms of silver. I mean, yes, gold is breaking out to new all-time highs. It's still very cheap. I mean, I think it's a great time to be stacking gold, but silver is just so cheap right now. It really is incredible with everything that's going on and all of the factors that are going to be contributing to higher silver prices moving forward. Right now, SD Bullion If you go to sdbullion.com/new and you are a new stacker, they are a channel sponsor. And right now, if you go to sdbullion.com/new, you can get gold or silver at spot for your first purchase. So a great way to start a spot deal when spot is very cheap. Anyway, check them out if you are interested in stacking some physical gold and silver. Now, what did Powell tell us? Well, I think after watching Powell's remarks that he delivered on Friday, it was kind of this Q&A session. Overwhelmingly, I think it came across as dovish. I mean, about as dovish as Powell can be, given the fact that inflation is still tending to tick up, according to many of the recent readings. Not Friday's, of course, but many of the previous ones showing that the Fed still has some work ahead of them. So, I mean, he really has to watch what he says. He has to kind of mince his words and try to control expectations here. But he did say, commenting on the PCE data, that this was along the lines of what the Fed wanted to see in order to begin cutting rates. And that is really one of the main drivers of precious metals prices. Now, there are more important things going on behind the scenes. Some of those things we'll talk about as we go through today's live stream. But for now, at least, it's the anticipation of more easy money from the Fed that is driving markets, whether it be the stock market, the debt market, or the precious metals, driving just about everything. That's what investors are focusing on. So when Powell tells us that this data is along the lines of what we want to see, again, this is a sign that I think Monday this week, we're going to see some more positive price action in the precious metals. He did say that they want to see more good inflation data before they begin rate cutting. Markets are still anticipating rate cuts beginning in June. I suspect that is probably what we are going to get. Yeah, of course, we have someone in the chat here saying, what about the inflation data being revised later? Well, yeah, that's something you got to look at. I think a lot of what goes on with these government numbers is they get released. They try to paint them in the light that investors want to see. So, lower inflation, then maybe it'll get revised higher later. Same thing with job numbers. And this Friday, by the way, we've got the non-farm payroll numbers coming out. That also could be a big contributor to movement in the price of the precious metals, being that if we get a weaker job report than is anticipated, that could put a lot of upward pressure on the precious metals, as that will kind of get investors perhaps thinking that the Fed is going to focus on their other mandate, that is employment, rather than price stability. But that being said, let's go back to what Powell was saying here. So also, Powell repeatedly commented on the strength of the U.S. economy. This is interesting, I think. This was in response to questions about whether or not the economy can withstand rate cuts in terms of inflation. And Powell basically says that what we've seen with rates above 5%, the federal funds rate above 5%, we've still seen a lot of strong growth in the U.S. economy. But it's incredible when you hear these central bankers talk. I mean, they never address the fact that the growth that we are witnessing in this supposedly strong U.S. economy is being entirely driven by deficit spending in Washington. Of course, Powell always makes a big point that the Federal Reserve doesn't comment on fiscal policy, meaning the policy of the federal government in terms of how they are spending money, and at this point racking up enormous levels of debt. He says that they're not a political organization. It's not their place to comment on this. However, he did answer some questions regarding this. A question regarding the U.S. was on a sustainable fiscal path at this point. And he acknowledged that we are not. He acknowledged that the current path of borrowing and spending that we are on is not sustainable. And his only comment on this was that the sooner we get onto a sustainable path, the better. But beyond that, I mean, he refuses to talk about the elephant in the room here regarding inflation and the U.S. economy, and that is the huge debt bubble, which is being inflated, which is ultimately going to lead to much higher inflation because all that debt is going to need to be monetized. And in that vein, Powell made some comments regarding quantitative tightening. That is the shrinking of the Federal Reserve's balance sheet. Here's a chart of the U.S. balance sheet, or the Federal Reserve's balance sheet, rather, by the way. And you can see this is the quantitative tightening, this little drop here at the end. Now, to be fair, that is more than $1 trillion of assets that the Federal Reserve has sold off of their balance sheet. And he said that the reason they were slowing down the rate of QT, that is the selling off of treasuries and mortgage-backed securities off the Fed balance sheet, was because in the past, in 2019, the Fed might have gotten a little too enthusiastic about drawing down their balance sheet. That created, you had problems in the overnight lending apparatuses. The Fed had to get back into the market, and you can see that on the chart here. Actually, you can see right there. The Fed started trying doing some version of QT back in 2018. They started drawing down their balance sheet. Now you see they had to actually begin increasing it again. That was before the pandemic. That was at the end of 2019, and that was because their drawdown had caused this lack of liquidity in the overnight lending apparatuses, the reverse repo facility, I think. I mean, I'm not a central banker, so this stuff is incredibly Byzantine and complex the way they run things. And a lot of that is just to obfuscate the reality of things. This is a way of them kicking the can down the road, creating all these complex financial instruments to make it look like a system is liquid when it's not. But nonetheless, he said that they wanted to avoid that, so they were going to slow down the rate of QT. And he always says, that they're going to get the balance sheet down to some desirable level. And he says by slowing the rate of QT, they can achieve ultimately a lower level because they won't run into some kind of problem. But, it's pretty interesting that he says they're going to get it down to some magical level. I mean, a level that he doesn't really entail. They'd like to get it down as low as possible, of course, because this whole thing is enormously inflationary. This is nothing less than debt monetization, Banana Republic style. And, where are they going to get it to? I mean, are they going to get it down to 7 trillion? Are they going to get it to 6 trillion? I don't think there's a chance of that. But ultimately, I mean, look at this chart. In order to get down to where they were prior to the great financial crisis here in 2008, I mean, they'd have to sell another $7.5 trillion worth of assets. And there's no way that these markets can sustain that kind of a drawdown on any timetable. So, I mean, to me, what Powell is really implicitly acknowledging here is that a lot of these assets are going to remain on the Fed balance sheet basically in perpetuity. Now, that's the opposite of what Ben Bernanke, the former chairman of the Federal Reserve, was telling us when they began this adventure in quantitative easing, when they began this adventure in buying up debt from the U.S. federal government, financing all of these massive deficits. He, told us it's not debt monetization. We'll normalize the balance sheet when the time comes. Well, that time is never going to come. And ultimately, I mean, this is going to move much higher. It's going to be going that way. When something breaks in this economy, we don't know when that's going to happen, but historically, the federal funds rate now, they've hiked it to a point where something in this debt-based economy that requires a constant expansion of the money supply and the supply of credit, something is going to break, and they likely will be returning to QE. Not only will they be ending QT, but they will be reverting to buying assets. I am very convinced of that. Powell said, is a recession off the table? He said that it wasn't likely, but you could always have one. That's another thing to keep an eye on. Every time historically, or not every time, but there's a strong correlation to the Fed beginning these rate cuts and having a subsequent recession. And so it's very possible that should the Fed begin cutting sometime in June or later this year, we may see a big recession follow that, one that is impossible to ignore. I mean, it's possible that we already are in a recession that's simply being obfuscated. Certainly, the economy is no rose garden, but it could be much worse. And let's see, what else did he say here? I have a few other notes that I took on him, I think. Well, anyway, I think that is actually about all I had for you on Powell. So I wanted to take a look at this chart of the federal funds rate and just kind of give you an idea of what I'm talking about, the potential for a possible recession moving forward. Here's a chart of the long-term federal funds rate. Now you see those gray bars, those are recessions, and you can see that in following the bursting of the dot-com bubble, the Fed was cutting rates, we had a recession. Great financial crisis, Fed was cutting rates, we had a recession. Here in the early 90s, you had the Fed cutting rates followed by a recession. In 1980, when they began cutting rates from the highs there where Volcker had hiked them to, you had a recession. So it's very possible that we may get a recession sometime following the advent of rate cuts. And when that happens, You know what they're going to do? I mean, they're going to cut rates even more. They're going to stimulate. They're going to buy up more debt. That is how just about every economic downturn or recession is met at this point. But one of the problems with that this time around is that inflation is already starting from a fairly elevated point. And this is sort of the logical conclusion that you can arrive at from this constant expansion of debt, is that eventually you're going to start actually debasing the currency by all of this borrowing and debt monetization. Now we're not there yet, but the signs have been on the wall. It's been written, the writing has been on the wall for a long time regarding the ultimate fate of the debt and the dollar and the trajectory we're on. One of the things I hear about gold and silver a lot, especially silver, is you start talking about silver breaking out from its long-term consolidation pattern that's been on for several years now. And you get a lot of pushback. I mean, I know sentiment around the metals is fairly low still. You can just look and premiums are low. And people out there say, well, I've been hearing this forever, right? I've been hearing that silver is going to break out forever. People have been saying this for years. And I mean, fair enough. I mean, it's true. Now, if you go back far enough, of course, if you're one of these folks who's saying, well, people have been saying this for 50 years, I don't really put much stake in those comments, because I mean, silver has had a number of significant bull runs over the past 50 years that you had plenty of opportunities to exit at a gain if you were buying during the periods when it was cheap, like it is now. But yeah, since 2011, it's been a long time. Silver has remained low for a long time. However, we do seem to be reaching an end game now in terms of the consequences of this borrowing. One way that you know that is that the interest on the U.S. national debt now is absolutely soaring. This is a chart of the average monthly interest rate on the United States total interest-bearing debt, and you can see that that's on the climb up now to almost 3.25%. However, that is going to continue rising, the average interest rate, until the Fed begins cutting rates. Now, if you do the math, I mean, we have about $34.6 trillion in debt. If you pull out your handy dandy calculator and you multiply that by 3.25%, you will see that now the interest on the U.S. national debt is just north of $1.1 trillion annually. And again, that is climbing, because you can take a look at the yield curve here for United States treasuries. And the cheapest treasury on here, the 5, 7, and 10 year, the low one at the lowest rate, is about 4.2%. If you go to the short end of the curve, it's closer to 5.4%. So look, as the old debt gets rolled over to the current interest rate, as new debt is created and treasuries are sold into the market at these higher interest rates, the average interest rate on the debt is going to climb. The debt is going to climb. And so, do the math there. You can see what's going to happen to the amount of interest. We're on track to have the amount of interest on the national debt become one of the biggest items on the federal budget, right? I mean, it already is exceeding defense spending at $1.1 trillion. Next up is Social Security. Next up is Medicare, the other two biggest items on the federal budget. And I mean, when the interest rate becomes, or rather the cost of servicing your debt, the interest on your debt becomes your number one largest expense on the federal budget. I mean, to me, that is a point that once you cross it, I mean, there's really no coming back. And we're going to arrive there very soon. I mean, we're already kind of at the point of no return when it comes to this debt. And so, I think when retail investors realize that, that's when you're going to see silver begin to move. So far, the majority of the movement that we have been witnessing, gold taking out new all-time highs, the price of gold moving up so rapidly as it has been over the past week or two, a lot of that is being driven by central bank purchases around the world. Now, central banks, they don't buy silver, right? I mean, the cost to store it, the cost to move it around, it's just not appropriate for central banks. So they're buying up gold. It is when retail investors catch wind of what is happening in the precious metals market that you're going to see silver really begin to move. And I think when the consequences of all of this currency debasement, when the consequences of this massive deficit spending and the massive expansion of this debt bubble become apparent to the public, I mean, they're already becoming apparent. Just look at how much the cost of living has gone up. Look at how much the purchasing power of your currency has been stolen by inflation, and yet people are looking to alternatives like Bitcoin. I mean, as far as I know, it doesn't even seem like people are really getting into gold in a big way. Sure, the price of gold is higher, but you go look at the premiums, they're still pretty reasonable. And that is how you can tell what the retail public is buying. When you start seeing the premiums of coins go through the roof, like we did last March when the banks were failing, that was when the public all of a sudden says, oh crap, we got to get some hard assets before the financial system starts to collapse. That's when you're going to see the price of silver move, because it is retail investors that are going to drive this stuff up, possibly institutional investors too, not in the form of central banks, but perhaps in the form of large businesses that require this stuff for the creation of their goods. It's very possible that a Tesla or a Samsung or one of these companies might come in here. We already know they're buying up, mines, and they're looking at that. They're looking to secure their access to strategic minerals, not just silver, but also nickel. All of these minerals. These companies are looking to get access to them. It's possible that they might buy up a bunch of silver. Now, the thing is, they're probably not going to be buying futures contracts just like a retail investor. I mean, if they actually need the silver to build something with, I would expect they want to get the physical thing. We looked at a recent live stream about how LBMA warehouse levels of silver are at a record low, around 800 million ounces, one of the lowest numbers on record for them. So, any of these things could trigger a massive run up in the price of silver. And, maybe you won't see that in the spot market right away. You might see it in the physical market first, in the form of rising premiums on physical. And one thing that we know just from previous events is that this can happen overnight. This can happen extremely quickly. I mean, it was the collapse of Silicon Valley Bank and subsequent crisis that ensued last March that began driving retail investors. And retail investors might be folks like you and me who are buying maybe a couple $100 worth of silver at a time. But you also got to understand there's a lot of people in the US alone, millionaires, folks with a lot of disposable cash, that if they get freaked out and they want to buy up a chunk of silver, there's really not that much of this stuff to go around at any given time. And so, it can happen very quickly that premiums rocket up and that physical supply dries up. Now, in 2023, they managed to kind of cap the damage to the financial system and get things under control. How did they do that? Well, they created the Bank Term Funding Program, which created a bunch of loans to these banks based on just false asset valuations, giving loans out to these banks on their treasuries at face value, when the market value is much lower. And again, maybe they'll do something along those lines the next time we see a financial crisis, but at some point, the consequences of that, are going to become very manifest. And they got a handle on the 2023 crisis kind of by kicking the can down the road. One of those banks, which one was it? I'm just kind of talking off of my top of my head here, but it was like Signature Bank, I think, got bought up by New York Community Bank Corp. That's one of the banks that we saw come under a lot of pressure just recently because they're taking a hit on their CRE portfolio, their commercial real estate portfolio, where we're seeing huge losses due to high interest rates. So, there's a lot of things out there in the financial system that could trigger a fright among retail investors, a feeling of insecurity and a desire to get their hands on tangible assets. And that's why I say, silver is set up right now. Now, it hasn't happened yet. Mercifully for us stackers, silver is still very cheap, because I'll tell you, it's not very fun to stack silver when you have to pay 20, 30, 40% over the spot price to get physical metal, and you got to wait a month or two for it to get to you because everybody is buying at the same time. So I do view right now as a pretty good time to be getting into the metals. In fact, I mean, it's probably about as good a time as you can imagine for a new stacker to be getting in here again if you want to stack silver, because silver is so cheap, even though these other assets like gold have already begun to take off. Bitcoin has already been taking out new all-time highs. Gold has been taking out new all-time highs. Look at what's happening to some other commodities. Look at what's happening to the price of cocoa right now. I mean, it's up like 5x in a very short period of time, an exponential increase in some of these commodities. And I think what we're headed towards is a major bull market in lots of tangible stuff, as the dollar begins to get debased, as the inflationary effects of all of the debt monetization and everything that has led up until this point are found, but also The coming rate cuts by the Federal Reserve, which are necessary to avert a financial crisis, the commercial real estate problems, the problems we see in the regional banking sector, insolvent banks with huge losses on their balance sheet because of declining yields on or low yields on their portfolios of bonds that we've seen actually an increase in yields that has caused the value of those assets to decline precipitously. All of this is something that really can only be resolved, one, by a massive financial crash and a shakeout, or by a return to easy monetary policy by the Federal Reserve. And look, central banks, they pay a lot of lip service to price stability, although, the fact that the Fed says we're aiming to debase the currency by 2% annually, I'm not really sure how strong of a commitment that is to stable prices. It seems to me like a commitment, a mandate for steadily declining value of the dollar and steadily increasing, prices. That is basically what they've told us. But the inflation that we're going to witness when the Fed returns to easy monetary policy is going to be far, far north of that 2% target. That's another thing that I think could be the trigger for a big run up in the price of metals. I mean, bigger than one that we've already witnessed is when the Fed perhaps acknowledges that their their inflation target of 2% is simply unrealistic, and they are going to have to revise that higher, maybe 3%. I mean, I don't know what the new target will be. Maybe they'll just revise the way they calculate the CPI so that the inflation rate stays 2% target, but 2% in the CPI won't mean the same thing as it did previously. I mean, this is one way that they repeatedly massage the data. We've got almost 500 people on the live stream. That's awesome. That's a little above normal. We got 125 likes. Do me a favor, if you're watching, smash that like button. Help get this information out there, because I think that there's a lot of people, when the bottom really does fall out of the dollar, they're going to be caught unprepared by this. And the more people that we can make aware of what is really happening, the better off we'll all be. The better off we'll be the more people get prepared, because we're not really being told the truth by the powers that be, by the political elites, by the central bankers. Surprise, surprise, right? Surprise, surprise that they would not be forthright with us. But they have an agenda, and the agenda is to inflate. That is what central banks do. That is how wealth is transferred from the poor and the middle class to the wealthiest in society, and that is exactly what we are witnessing. I'm going to change gears here a little bit, and this is going to be a long one, folks. We're already at 27 minutes, but I've got some more stuff queued up for you here. I want to shift gears to the geopolitical front here briefly, because this is going to have a huge impact on the price of gold and silver as well. And I mean, the whole world right now is basically a powder keg, and I think that people aren't really pricing in the risks here regarding commodities specifically. So we've got Zelensky now telling us, according to this Reuters report, that without more U.S. aid, Ukrainian forces are going to have to retreat. So we're going to start off here with Eastern Europe. So suffice to say, the conflict there is continuing to escalate. And now this is either going to mean more and more billions of dollars that are borrowed money, money that will ultimately have to be printed by the Fed, is going to be funneled into this conflict. Or alternatively, we may see NATO troops coming into direct conflict with Russia, which we're going to kind of go through a couple stories here real quick, and I'll tell you why this is relevant to the precious metals, because it really is. Following the terror attacks in Russia, we have got now Russia acknowledging the word war. They are in a state of war. This is according to Dmitry Peskov, the Russian spokesman for Vladimir Putin, the Kremlin spokesman. Now, we have got Russia saying they're in a state of war. That is different from the special military operation, though, the term that they were using following their invasion of Ukraine in February of 2022. Now the verbiage has changed, and they are acknowledging they are in all-out war. So you see, this is going to escalate into an open conflict between Russia and NATO. At least that certainly seems to be the direction we are headed into. That will be very bad for the U.S. dollar, if you ask me, on many counts. One is that, we're going to be printing a lot of money to funnel into this. Huge amounts of resources will be poured into this conflict, resources that we don't have. So they're going to have to be borrowed. And, war is one of the most costly, one of the most inflationary endeavors a nation can engage in. Just look at the history of hyperinflations. Many of them follow major wars. It is not unusual for that to be the case. Now, we've also got the Middle East heating up. According to this report from March 29th, you had an Israeli attack in Syria, deep into Syria territory on Iranian proxies. This is a strike which led to dozens of casualties. So, signs of a broader war in the Middle East breaking out. You've got Japan now building civilian bomb shelters, according to this report from the Eurasian Times, amid fears of a Chinese attack on Taiwan engulfing the region. So, we need to really be on the lookout here as 2024 plays out for conflict to break out between the West and any of these nations. Look, the three countries I just named that are really involved here: Russia, Iran, operating via proxies in Syria, China in Taiwan. These nations are all members of the BRICS organization. This is no surprise that this is happening. These are not unrelated events, okay? I mean, you've got to understand what is really playing out before our eyes here. It is a bifurcation of the traditional post Second World War order where we are seeing the world break into these rival camps. Now, what does this have to do with the precious metals, though? I mean, aside from inflation being created by all of the war spending, well, the World Gold Council tells us that central banks accumulate more gold in January, starting 2024, as they mean to go on, indicating that 2024 is going to be another big year for central banks buying up gold. So that is one of the drivers of the current bull market in gold, is central banks accumulating this stuff. Why are they doing that? It is to prepare for de-dollarization. Now, if you see conflict break out either between NATO and Russia, between the US and Iran, the US already at war with Iranian proxies via Yemen, of course, so that war is in some ways already begun. If you see a war break out in the South China Sea, these things will all be related. It's possible this all plays out at once. What do you think these central banks in China, in Russia, around the world are preparing for? Well, they're preparing to dump the dollar in a coordinated manner, or at least that has got to be one scenario that they have in mind. You hear all this talk about cyber infiltration of U.S. critical infrastructure by hackers from China, from Iran, from Russia, around the world, our opponents on the geopolitical chessboard. Yeah, I mean, they're positioning themselves to have these various attacks that they can pull off when they deem the time to be necessary. Maybe they can't fight the U.S. in a conventional head-to-head war. Maybe they can, considering the fact that this is a multi-front war for the U.S. Even the giant U.S. military juggernaut, I think, might struggle with a three or greater front war. But look, they're not going to leave it to kinetic battlefields, right? This is going to be the fifth generational war. This is going to be the war on infrastructure, on cyber assets, on financial targets. I mean, we've already seen the dollar weaponized. So far, the financial warfare has been kind of one-sided in this conflict. But as things escalate, it is very likely that there could be a coordinated dollar attack by these nations. I mean, it's reported that they, by themselves, by the way, the BRICS nations, they're working on an alternative reserve currency to rival the dollar. Now, that may very well be based on gold. I mean, the Iranian and Russian central bank, for more than a year now, have reported that they are working on a gold-based stablecoin currency for cross-border payments. They also tell us that one of the big agendas under the Russian presidency of the BRICS organization in 2024 is going to be the creation of this alternative monetary system to rival the dollar. So, I mean, it makes sense to me when you see central banks, according to this World Gold Council data, loading up on gold. They said they saw hardly any selling in January. And for years now, they've been loading up at a record pace, the biggest pace on record. The reason for this is the preparation for de-dollarization. So, look, I mean, you've got the Federal Reserve, the domestic economy, the Federal Reserve, they're going to be cutting rates. I mean, they have to get back to easier monetary policy, or they're going to let the whole system collapse. I mean, I guess you have to just kind of pick your choice. What do you think they're going to do? Are they going to opt to inflate things and run the printing presses? Or are they going to allow a systemic collapse? My money is on running the printing presses. There's nothing that they have done over the past several decades to indicate they would choose anything but that. You also have the world on the verge of a major conflict. It appears to me, from my point of view, that World War III is already underway, one of the consequences of which could be a coordinated attack on the US dollar. And I mean, nobody is preparing for that, or at least very few people in the mainstream. This is not something you're going to hear on CNBC. This is not something that you're going to read about in the Wall Street Journal. And yet, this is a very real risk. And so, to me, this is all incentive to have some hard assets on hand. Prepare every way you can. Maybe silver's not the metal for you. Maybe you just want the sure thing. You want something which is perhaps a more stable, a less speculative store of value. Go for gold. I mean, sure, it's at record highs right now. I still view it as very cheap. But if you really want to get the value, the bargain, the unloved asset right now, silver is it. And, as early as tomorrow, I think we could see some big moves in silver. We've looked at the technical chart. You can go back and look at past live streams. Silver is in a consolidation pattern, which it is almost certainly going to break out of one way or the other between now and 2025. I don't have the chart pulled up right now, but you can go back and look at the last live stream. I think I showed it. And the fact that gold is breaking out to new all-time record highs, that to me indicates that silver is ultimately going to follow. It's probably not going to happen until the retail public decides to get involved in these markets. That could happen overnight. All it's going to take is one story regarding, the insolvent banking system, regarding a escalation of conflict. There's somebody in the chat who's constantly talking about the goldbacks and how they're a scam. Well, look, you might think they're a scam, but I can take the goldbacks that I bought a couple years ago and sell them for way more than I bought them from. It's a very liquid market, very narrow spread. So yeah, the premiums are high on them. Guess why the premiums are high? It's because they're 1/1000th of an ounce of gold. I mean, the premiums are higher on a 1/10th ounce coin than they are on a 1 ounce gold coin. So what do you think happens when you have to make 1,000 units out of 1 ounce of gold? Yeah, the premiums are going to be a little higher than on a kilo gold bar. But I think the utility there and the performance is, it's not even worth debating. It's just a fact that you still would have been better buying gold. Well, not really. I mean, someone in the chat said that you can go look at the price performance of goldbacks. It is right up there with gold. In fact, if you you can just go on eBay if you want to see market data. Do an eBay search for goldback listings that have ended, and you can see they are selling for a huge premium, even over the official value of the goldback. But anyway, look, I mean, this isn't a video about goldbacks. Maybe we'll have some more of those soon. But I'm very happy to have the goldbacks that I have. Also, not to mention the potential utility for using them in any kind of an exchange scenario. I mean, it's a huge thing. But yeah, this video is not about goldbacks. Just go look at a chart of goldbacks price if you're interested, and you'll see that they have done very well. And if you have some of the early issues, they are in particular have performed very well, because there's kind of a collectible aspect to those as well. But anyway, that's it for today, everybody. Happy Easter. I hope that you all have a great weekend. Keep an eye on the price of gold and silver tomorrow. It could be a very interesting week for silver and for gold indeed. Let me know what you think in the comments down below. Do me a favor, smash that like button. Share the video with your friends, and I will catch you next time, everybody. Stay safe and happy stacking. Smart Silver Stacker, out.